Hi guys, I'm glad you're here to see this presentation. It means you've clicked on and you've hopefully read the paper on how to construct an investment portfolio like the ultra wealthy. Now, look, it's really great that some people are interested in creating a portfolio that lasts the test of time. Look, I know it's not an exciting subject, and it's not something here to sell you the hottest investment tip or something that's very exciting. But all I can do is just share what I've learnt over the past 2 decades advising ultra wealthy clients and allowing you to just enjoy the experience that I've had so that you don't make the same mistakes I've seen others make, particularly in Australia with their super fund savings. So let's get started. Now, hopefully you have read the paper. I know many people read articles like it, and I know it was quite lengthy for some people. They take it all in. They see how it fits. It does not fit into their investment strategy, and then they do nothing. Right? Ultimately, it becomes an intellectual exercise for people. I hope that's not the case here with the viewer. It's something that I really think that people can take advantage of. It just if they do something. So taking an action is the most important step. So what follows in this video is a response to questions from the original paper on how to construct an investment portfolio in Australia. Now, I've distilled the responses down that I've had to answer repeatedly into pretty much what the most pressing question is, which is just what is the number one tip, or what is the one thing that people can do in order to invest like the ultra wealthy. And that really comes down to what does the portfolio look like. Now, in order to get there, I think it's important that people understand why. It's easy to just follow the rules about portfolio allocation, etc., but I think there's a lot of advantage into understanding why and the fundamentals behind the strategy. So one fundamental, and I think everyone can pretty much agree, is that the future is impossible to predict. If everyone could predict it, then there would be no way to make money. If no one can predict it, well, then you'd have random markets, which is pretty much what we see. So anyone who thinks they can predict the future, it usually gets unstuck at some point. Now, what we do know is that the future will fall into 4 basic economic scenarios, right? There's rising economic growth, there's falling economic growth, there's rising inflation and falling inflation. That's pretty much the fundamentals of economics, right? Now, what people often don't understand is there's different types of assets do well in each of these scenarios and they do poorly in other scenarios. So the portfolio strategy contemplates allocating a quarter of a portfolio's risk, which is different to portfolio of assets, so portfolio's risk, into each of these scenarios. Now, this portfolio is not about getting the highest possible returns in any quarter or year, but it's about creating a portfolio that has a behavior of cash, i.e. it just grows steadily, but with far better returns. So let's talk about cash. Right? Now, when looking at any investment, it's very helpful to consider it as a function of the following. Right? It's a return on cash, which is the official cash rate from the RBA, the excess return of a market, so say the All Ords index or the housing market or the bond market above that cash rate, and the stock selection you can do which is better than the market. So the market return is often referred to as the beta, and the returns you would get above, over and above the beta is called the alpha. So when you see fund managers looking for alpha or things like that, that's exactly what they're trying to do. They're trying to beat the market. Right? Now, often fund managers in Australia, I found, they like to blur the distinction between the moving parts of those, so the cash, the beta, and the alpha, or hide it completely, and it really makes it difficult to assess exactly what their performance is like, and also to assess the attributes of any one part or the whole of the investment return. So in Australia, like I said, the return is the cash plus beta plus alpha, which in layman's terms is the RBA cash rate, which is the official cash rate from the RBA, which is set every month, the general market returns over and above that, and then the return from your trading skills in that particular market that you're trading. Right? It's no more complex than that. Right? So understanding any investment, I'm going to walk you through an example here so that you can understand the concepts a little bit better. So we're going to have a look at, I picked almost randomly a stock BHP, which everyone knows, and I picked randomly just 1 year, which is 2007, so I could break it down for you. And as you can see here, the cash rate was 6.25% back in 2007. It's a shame those days are gone. And we also saw that the market, which is the light blue line, or light blue area of the bar, it made 18.57%, and then BHP did better than the market by an extra 8.42%. So basically your total return was 33.24% for the year. And if you look at that broken down into those parts, you may think, oh, I'm a genius for picking BHP that year. But most of the return was on choosing which market to be in, not on choosing the actual stock within the market. And it's important to understand that, right, when you break down each asset or each investment you do into those. If you look at BHP for the 6 years, over 2007 to 2012, you'll see that the official cash rate was always positive, some more positive than others. The All Ords index, which is the light blue shaded area, is both positive and negative, and BHP is also both positive and negative, not always in line with the market. So sometimes it went up and the market went down, sometimes it went down, the market went up. So it very much is a breakdown of returns, gives you a very different story. Now sadly, what you'll see in the Australian press is what you would see normally is just the BHP line, which is a red line I've overlaid here. Now there's only really three things you can do to make good returns on your market, right? You can have better choices of each individual investment, you can have better timing than what other people do, or you can have better portfolio allocation. Now the first two is really difficult, right? The alpha and the timing is really difficult to achieve. But the one thing you can have control of, and usually is lost with people investing here in Australia, is portfolio allocation. It's the one thing you do have complete control over, and it's the one thing that can really influence your returns. So I'm going to go back to what I wrote in the paper and just a quick check again with the principles. So when I talk about risk, and I really worry about the risk of the investment first before I do about the return, risk parity is a term that focuses on building a portfolio and allocating weights based on risk rather than dollar weights. Now, risk parity is the backbone of what you see in the four quadrants, which I mentioned in my paper, and has the roots in modern portfolio theory by Harry Markowitz, who eventually earned him a Nobel Prize. And they talk about modern portfolio theory. It was introduced in the 1950s, so it's actually not modern anymore. But certainly that's how it's referred to if you have ever studied economics. And what it suggests is a concept of an efficient frontier, which is basically the allocation that offers the highest return for any given level of risk, and vice versa, so the lowest return for any given level of return. So when you combine that with a theory of a few others, Sharp and Tobin and Trainer, etc., going off tangent here a little bit, you will see that it demonstrates that a portfolio can give you an optimal amount depending on the selection of assets you have in that portfolio. So in the portfolio that I have learnt and studied with regards to my ultra wealthy clients, it really comes down to the four quadrants: the rising and falling economic growth and inflation, and choosing which bonds, which equities, which commodities to go into each of those quadrants in order to have a well-balanced portfolio that does well no matter what happens in the economic environment. So risk is defined in very different ways, but volatility is a very simple example of how to measure risk. And volatility is pretty much just how much is that investment going to move around? What are the swings and roundabouts with that selection of investment? So let's have a look at that. The risk and return on Aussie bonds and stocks. I know Australian investors are really big into Aussie stocks and have done really well over the last 20 years, 25 years. And as we can see in the graph I'm showing here at the moment, the red line is the ASX 200 accumulation index, which shows the growth of your portfolio over the last 10 years and assumes you've reinvested your dividends back into the market. So the red line shows not only the All Ords, but also assuming that you reinvested all the dividends you received during that period back into the market. Now the green line is the equivalent Australian bond index. And as you can see, both indexes show about the same return, about the same start, about the same finish. And you can see how the red line, the ASX 200, has had massive swings, ups and down. This reflects the risk that you're taking when you buy shares. Now, having a look at the bond market, there is very little swing, which shows, conversely, just how little risk you're taking in your bond portfolio in order to achieve the same return. So it is something that is important for people to understand, so that if you're going to make an investment, what are the risks, what are the returns, and am I getting the best return for the risk I'm taking? So the returns are about the same over time. I'm going to overlay it here again. This time the bond market is the white line with the area shaded underneath. The ASX 200 is the red line, and again it's the accumulation index. So I did it over a longer timeline here. This is 20 years now. And as you can see, yet again, the volatility equity market is still prevalent and the returns are still similar for each market. So it's never the return that sends investors broke. It's the swings that hurt. It's the guys who don't accept the downside or don't see the downside coming. So it's very easy to think, okay, if I bought at the low, I did really well at the high. But think about what would happen to your investments if you bought at the high in any of these swings. And that's the beauty of looking at different markets like the bond market and understanding I can complement my equity portfolio with a bond portfolio. Now, a strategic investor allocates cash to a broad range of assets so that one downswing is offset by another asset upswing. And I'll show you even more granular example of that. So back to my original premise that each asset does well in different environments. Then more importantly, you really need to understand that statistically, and history has proven this over and over again, you've got very little chance of choosing which market is going to be the next big thing, right? You always hear stories about these massive winners, etc., but usually the guys were just lucky. Sometimes you do see a structural shift, but for most investors they don't. So there's a bit more colourful graph here. I'll explain it a little bit to you. The red line is still the All Ords Index and the white line is still the Bond Accumulation Index. And I've overlaid two more here just so people understand what the allocation would be for a normal wealthy portfolio. And the green line is actually gold, and the purple or magenta line is the commodities index. So it shows that some do follow in sync, some don't, but over time those asset classes are usually what I see in portfolios that are done by the ultra wealthy. And I bring it up, and the reason I did this is that I found that the ultra wealthy family are very different in their investment allocations than what the general mums and dads and the general population was, and even right across the board. So both in Europe and in the US, where I've had clients, and as well back in here, even exaggerated here more so by the reliance on both equities and property in most people's portfolios. So turning those principles into a portfolio, and when you take into consideration the risk, what is generally referred to as the all-weather portfolio looks like this, right? You'll have about 30% of your portfolio in stocks. You'll have bonds to be about 55% of your portfolio. Commodities at about 7.5% and gold at 7.5%. Now, most people are going to look at that and say, well, that's far too much in bonds, and I get that. I understand where the Australian psyche is, but all I'm doing is relaying information about how billionaire families or multi-tens of millions or $100 million families invest their money, insofar as they're investing for not only their own lifetime, but the lifetime of their kids. Now, they will take selected positions in stocks and bonds and commodities and gold when the timing is right, and they reallocate depending on what part of the environment and cycle is with regards to economic environment, inflation, etc. But if I break it down even further, and I know this portfolio goes against the general wisdom you hear in Australia about making your money grow, but just say you had 50% stocks and 50% bonds, which is considered a balanced portfolio by some super fund managers. The reality is generally stocks are 3 times more volatile than bonds, if not more. So your risk, if you look at it from a risk perspective, rather than 50-50, you're looking at 95-5. And that's just not balanced. Anyone who calls that a balanced portfolio is just wrong. I don't know whether they're deliberately lying to you or they just don't get it, but that is just an incorrect statement to say it's a balanced portfolio. Now, the ultra wealthy portfolio, when I break it down into the type of bonds, they'll have medium term bonds at 15 and long term bonds at 40%. So it's even broken down even further than that, and I could, in probably future pages or papers, or if you ever wish to contact me, broke down those bonds into fixed rate, floating rate, and inflation linked bonds, which all do well in different types of environments. But what this portfolio is meant to do is to withstand any one market collapsing, and making sure that the risk return profile ensures that you maintain a guaranteed income stream to live off for not only your life but for future generations. And at any point in time, which stocks or bonds to pick will all depend on where value is within that market. And if you have a structure like this, you will afford yourself more time and more flexibility with regards to buying which bonds and which stocks which are of value at that point in time. Now, just remember, this portfolio is generic. I've had no input with regards to, and this is not meant to reflect what your own needs are. All I'm doing is just sharing decades of experience with regards to investing on behalf of and advising the ultra wealthy. Now, I'm certainly not reinventing the wheel. This is a portfolio construction, this or something similar to this. I've seen numerous times now in ultra wealthy families, and there is a pattern of behavior with them. Now, of course, this looks like a bond-heavy portfolio, and it's going to perform better in down years, and that's okay. That's what bonds are for. They act as portfolio stabilizers during economic downturns and stock market crashes. And even on the upswings, they still do well, and they provide you with a base in which to leverage some stock selection in the good years. Now, each one of these asset classes over a very long period has a good winning percentage over the long term. Now, combining them together, this is what I've realized is really ultra wealthy families and people who want to invest money in order for it to grow without the volatile spikes. Really having a combined portfolio of each of those asset classes lowers the volatility of their portfolio, so they never get stuck if they suddenly need the money or things don't go well or don't go as planned. Now, what do you do now with this information? I've shared with you some would say a long-winded presentation or a paper on how to invest and how to construct a portfolio like the ultra wealthy. I've now given you a quick upshot and a little bit more detail on the construction of the portfolio. So if you want to reduce the swings in your portfolio without giving up the returns, and that's just it, you don't have to give up returns in order to reduce the volatility, this is what you need to do. Give me a call. Just give anyone a call at the Australian Bond Exchange. Someone will pick up the phone, 8076-9343. Or you can email me at bradley.mccosker@bondexchange.com.au. Ask any question. I'm happy to answer them. I love this topic of conversation, so please feel free to call me or feel free to email me, and I'll do the best I can take both questions, feedback, because I just want to make sure that as many people as possible understand how to make the most out of their investments while still enjoying the benefits of guaranteed returns, which is basically what bonds are. When a company issues bonds, they guarantee the return. In fact, what I might do is I'll probably do a paper on explaining in detail the types of bonds, etc. So I know in Australia it's a very new field or old field, but it seems to have been lost in the lexicon of the last, say, 15 years. But it is something that you can take advantage of right now. But at the end of the day, you've got to make the first contact. I've reached out to you. I've shared this. I made a commitment some time ago to share this with people in order to allow them at least the opportunity to invest in things that they may not have previously been able to do. And I'll just make a clarifying statement here. If you come to the Australian Bond Exchange, we'll provide you with direct access to actual bonds. It's not a bond fund. It is bonds that have maturity dates. They'll have capital guarantees by the companies that issue them. So it's different to what you'll normally see for mums and dads. We can provide this now for the first time in Australia through the Australian Bond Exchange to allow mum and dad investors to invest in corporate bonds in Australia down to marketable parcel size of about $10,000 depending on the bond, which it really opens the door to people to start getting some guaranteed returns and a bit of stability back into their portfolios. So I do hope you take advantage of this opportunity. Thank you very much.